Hello friends, after a short break we are back, this time with a popular topic, the turnover method for working capital finance. This was a NIAC committee recommendation. As per RBI norms, you can assess MSME loans up to 5 crores using this method. First, I will discuss the turnover method assessment steps. Then, explain the concept with a case study. But it does not end there. You also need to understand the limitation of this method before applying it in your assessment. I will guide you regarding that as well and make you ready for your next assessment. So stay tuned till the end. Before we begin, can you tell me what is meant by turnover? Turnover is nothing but the gross sales achieved by a firm or company in one particular financial year. Now, let us see the turnover algorithm step by step. First, you need to decide the accepted value of the projected gross sales. Next, you need to calculate the working capital requirement based on it. Nowadays, it is 33% of step 1. But this entire working capital will not be funded by the bank. So you have to consider the margin which is to be pumped in by the promoters. Once you have computed the margin, you have to deduct the same from the working capital requirement. This will give you the eligible amount which you can finance. Now, let's go through the step in detail and understand with a case study. First, you must arrive at the gross sales which you will consider in your calculation. To do that, you need to understand which year projection you should take in account for your assessment. You need to take projections up to financial year in which the limit ends. Suppose you are sanctioning the limit in May 2019 and it is valid for April 2020. So, what is the financial year for April 2020? It is March 2021, right? So, you need to take figures of March 2021 for your calculation. I have seen many people making mistakes in this step. Next, you should know what to accept as projected gross sales. There are many who advise me थोड़ा देख के करना है, but what to see they could never tell me clearly. It's much more than a flat 125% increase concept. It depends on the type of business. We start taking audited figures of last 2 years. This is in order to understand the growth rate of the sales. Normally, banks accept sales growth up to 25%. Anything beyond 25% has to be justified logically. For example, let's say the company can show you sufficient orders in hand to surpass 25% growth, then you may accept the same. Be careful while scrutinizing the orders in hand. Inquire how much time it will take to complete, deliver, and receive payments. This will give you an indication of the operating cycle of the business. Keep an eye on the capacity of its plant and machinery, storage capacity of raw materials and finished good before you accept a remarkably high gross sales. It should not be like building castles on air. I use the following tools to check if the company is in track to achieve sales for the estimated year. Total credits in the account till the date of appraisal. Our CBS system are well equipped to generate such reports, I believe. Watch out for the bounce check, RTGS, NEFT since they artificially increases the credit sales. If he is a new customer for your bank, don't tell him to open a current account. Check his transactions in whichever bank he is operating. For small loans, you can check his savings account as well. GST returns till last month or quarter. This will give you sales figures of the company. Provisional balance sheet till last month or quarter. I hope this comes handy when you do your next appraisal. Now I will tell you how to calculate the working capital requirement. It's around 33% of the projected gross sales. Earlier it was 25%. The logic behind this 25% or 35% I will explain later, so don't worry. This is the total working capital requirement of the company for entire year, including its own margin. Bank will not fund this totally. In order to understand how much we can fund, you have to calculate the margin which is to be subtracted. Please note this is the maximum limit assessed by the bank for next 1 year. Once it is fixed, it cannot be changed. If you want to change, you have to start the process from the beginning and accord a fresh sanction. Now, let us understand how to compute the margin. Generally, it is 8% of the gross sales or NWC for the projected year, whichever is higher. Again, the logic behind this 8% you will understand if you stay with me till the end. Let us quickly see what is NWC. In this balance sheet, you have a current asset of rupees 100. As we know, most of the current assets are financed by current liability. Here, it is rupees 70. When you subtract or net out this current liability from current asset, you get the NWC. Here, it is rupees 30. In other words, NWC is the long-term sources for current asset funding. Generally, it is funded by the promoters, but there can be exceptions too. I will not go in much depth of NWC. For the simplicity of our understanding, we may consider NWC as promoter's margin for the time being. So, the eligible bank finance will be working capital requirement subtracted margin. That's it. Now you know how much you can finance. Let us see the whole thing in a case study. So, continuing with our earlier example, we are assessing a limit of a company in May 2019. We have to take audited figures of last 2 years, the estimates for financial year 2020 and projected for financial year 2021. When you put these figures side by side, it will help you to compare year-wise increase or decrease. Our accepted gross sales figure for financial 2021 is rupees 600. Its 33% works out to be rupees 198. Now comes the tricky part, margin. First we calculate 8% of the sales, which is around rupees 48. But that's not enough. We must also check the NWC. This is where your balance sheet figures comes handy. The NWC works out to be rupees 50. Since 50 is greater than 48, we have to take 50 as margin and subtract the same from the working capital requirement arrived at step B. So your eligible finance comes to rupees 148. Observe carefully, if you wrongly take NWC of financial year 2019, you will end up over assessing the limit. Wait, it's not over yet. I have a good news and a bad news for you. First, the good news. You have learned the technicalities of turnover method. But now the bad news. It will be a disaster if you start financing by quitting the slideshow now. You need to know the limitations of this method before you start applying it practically. Let us think. A loan of 15 lakhs was assessed in turnover method. The sanction terms, apart from having usual condition, it is mentioned that debtors up to 180 days to be considered for calculating drawing power. Do you find anything wrong with this? Have you used turnover method for financing a local sweet shop, a hotel or restaurant, or a beauty parlor? Can you guess what can go wrong? Before we get to the limitations, let's quickly see what is our operating cycle. Every business starts with some cash. With that, it purchases inventory, then makes a sale. But this sale is mostly done in credit or udhar in popular terms. So it gives birth to debtors, which takes its own time to get realized to cash. Then this cash starts another cycle and this process continues. Journey of a business from cash to cash is called operating cycle. It is represented in days or months. Now, turnover method flatly assumes that all business will have an operating cycle of 120 days. Earlier, this was 90 days. Not more, not less. And the working capital requirement of a business should fund one operating cycle. So 120 days of 1 year is roughly 33%. Our turnover method flatly takes 33% of gross sales as working capital requirement. It also says margin of the promoter should be 25% of this 33. It comes to 8% of gross sales. So what will happen if you finance a business with shorter or longer operating cycle other than 120 days with this method? Let us see with a case study. Let us talk about a business whose operating cycle is of 30 days. 30 is around 10% of 365. So working capital requirement shall be as under. Margin must be 25% of 10, that is 2.5% of the gross sales. Here I have calculated the reversed working capital requirement, which is 60. The margin has to be revised accordingly. But the NWC remains constant at 50. Now, this is what the company is supposed to get, that is the eligible working capital finance. But this is what you have actually sanctioned. So, you have made an excess finance of 138. What could be the possible outcome? Diversification of fund outside the business. Now, can you tell me why our guideline still says to finance in turnover method? For small business, there is no fixed operating cycle. The business owner himself does not know what is his operating cycle. So, if we are stringent in financing small units, we cannot finance at all. How to mitigate that? You have to regulate the drawing power efficiently and increase the limit in phases. Now, let us see what will happen if the operating cycle is for 180 days. 180 is around 50% of 365. So, working capital requirement shall be as under. Margin must be 25% of 50, that is 12.5% of gross sales. Again, the working capital requirement has to be revised accordingly, so as the margin. Finally, your eligible working capital finance will also get revised. But this is what you have actually financed. So, your selection of turnover method has led to underfinancing of this company or firm. What could be the possible outcome of this? The business will suffer from a cash crunch. They will borrow from outside, repay that loan first, and then think of your repayment. Company might fail to achieve projected figures and it will be difficult to renew the account. What are the mitigation steps for this? You have to switch to MPBF or cash flow method of assessment of working capital. Before we end, be cautious of some business which has almost nil or very small operating cycle, like hotel or restaurant, beauty parlor, sweet shop, petrol pump, tea stall, pan or cigarette shop. Financing these with turnover method can cause huge overfinancing and diversion of fund. There might be exception if they have some corporate or wholesale clients who are clearing bills on monthly basis. But you must understand the business before you take exposure. You can always fund the portion of working capital requirement where debtors are involved. So friends, that's all for now. I leave you with a sample process note given in the description of this video. You can watch my other videos which are now getting reflected on your screen. If you like this video, don't forget to like and share it with your friends. See you next time. Goodbye.